Thanks, Olivia, and good afternoon to everyone, and thanks for joining us today. Just a very short comment from me, really, for those who don't know who we are. My name's Steve Jones, and I'm joined by James Maynell, and we're partners with Ballards LLP, a firm of chartered accountants based in Worcestershire. We're a 10-partner firm, about sort of 70 professional staff, and been going for about 35 years in the area. We offer all of the usual services you'd expect from accountancy practice, accounts, audit, taxation. I think that we're probably best known for our tax planning, but also something that we're very keen on, which is relevant at the moment, is real-time and cloud accounting using Xero, QuickBooks, Free Agent, Cashflow, and all the other sort of platforms. Why we like those at the moment is not only are they pretty intuitive pieces of software themselves, but they do support sort of an ecosystem of apps that you can add on pretty cost effectively, which make your life as business owners and business operators easier. Things like Receipt Bank, which automates all of your invoices, etc., and Chaser, which automates the credit control. And automation doesn't necessarily take away the human element. What it does is it automates a lot of the compliance side, which frees up your time to be doing what you want to be doing, which is driving the business forward and sort of strategic thinking. As well as that, it frees up our time from pressing buttons and twiddling knobs, and allows us to spend more time with you as our sort of clients, hopefully delivering what we like to do, which is strategic, sensible, practical business advice. Something that undoubtedly is going to be very important to all businesses going forward, from an advisory point of view, is cost control and reduction. So I think that's going to be something we're going to be talking about quite a bit over the coming years, undoubtedly. So that's enough from me. So I'm just going to hand over to my colleague James Maynell now, who'll take you through today's webinar.
Steve, sorry to interrupt. Sorry to interrupt, James. Just before you do that, I think a couple of people are commenting in the group chat that they can't see the presentation. Could you stop sharing your screen and then reshare your screen? Just to see if that might change things. Just a couple of people have said they've got the same issue.
Yep, no problem. So if I go to share screen, click that.
Okay, yeah, I can see that. Is anyone able just to comment in the chat if they can see that now? Yeah, there we go. Sorted. Sorry to interrupt.
Great, thanks.
Okay, no problem. And thanks, Steve. Well, again, thank you all very much for joining us this afternoon. And first of all, I should say that I'm speaking from home, so please forgive any of the noises of domestic life that are likely to intrude. There's homeschooling going on downstairs, and my children are aware that I'm doing this, but they are likely to forget. There may also be dogs and cats making themselves known, but fingers crossed. In terms of the timings, I think this webinar should last around 30 minutes. So it won't be too long. And as we've said, please use the group chat Q&A. I'll have a look at the end and go through anything that's come up there. So to introduce myself, I'm James Maynell. I lead the consultancy and advisory service lines at Ballards. I've 20 years of experience as a specialist in corporate finance and advising businesses on operational matters. During the last downturn, when the transaction market collapsed, I moved into operational restructuring, advising companies and their owners on how to get the best value out of their existing assets rather than acquiring others. And since then, I've worked with many businesses of all sizes and various industries on getting the most value for money when they spend on operations. I balance this with supporting businesses as they're bought and sold, which has ended up giving me a broad and deep experience in finance and operations. So I'm going to talk to you, as Steve said, today about cost reduction. Always a hot topic during times of economic difficulty. As business owners and managers, you'll almost certainly have felt the impact of the coronavirus in some way, and hopefully you'll have taken advantage of all the government schemes available to buy yourselves any necessary time. But when circumstances mean that business owners have limited control over their revenue, the only remaining avenue to profitability is focusing on the cost base. But whatever the situation, it's always worth being aware of what interventions you might make in spending to maximize your profitability. Yeah. Some businesses need rapid tactical changes to their costs, and others need more measured structural interventions to their cost management. And so the objective of this webinar is to look at what interventions can be deployed to understand the principles of cost control, understand the main areas to target for cost reduction across a range of industries, understand the value of a planned and targeted cost reduction program for all entity sizes, and finally, to understand the importance of tracking the benefits of your cost reduction program. So why might cost reduction be necessary? There are many reasons why a business may want to implement cost reduction. A business may be pre or post acquisition or divestiture, and therefore looking to maximize value for the buyer or seller, or it might be looking to store cash for any potential acquisitions it might want to make. A business may be experiencing a short or medium-term revenue drop as a result of a specific event, such as coronavirus. Such a business will be looking to protect margins by putting a stop to discretionary or unnecessary spending and secure any potential funding to bridge gaps. Revenue may be growing, but margins may be decreasing, implying that back office costs are out of control. Sustainable growth is only possible with active cost management in this situation. There may be a long-term revenue adjustment requiring a wholesale review of business priorities and a redesign of the back office functions to ensure survival. A business may be under stress, in danger of breaching any debt covenants put in place. This will inevitably lead to difficulties in refinancing and require the release of any cash available. And finally, a business in distress will require immediate release of cash in order to survive. And so whichever set of circumstances applies to your business, a systematic approach to managing the cost base will give you the best chance of success. Now, for a few guiding principles, in my experience, a best practice approach to cost reduction is methodical and governed by 4 guiding principles. Now, number 1, you should plan for 3 to 5 major changes only. Each change plan should make a fundamental difference to the company's operating model, and each initiative should be visible and measurable in the company's financial statements. Number 2, each planned change should be based on an unbiased and independent analysis of the company situation. You should have clarity on the cause of the company's distress, acknowledge the new market realities, and take these as the starting point for your assessment of the business. You should always focus on changes within the company's control. So if, for example, the business plan relies on sales growth to be achievable, there needs to be strong evidence of supporting initiatives to achieve this growth. Number 3, you should be able to demonstrate the company's ability to succeed before the cost reduction plan is finalized. You should plan for early wins and have a visible and significant impact in the company's financial reporting. Changes that are clearly difficult for management should be made early to demonstrate commitment. The expected impact of the cost reduction should be modelled in as much detail as possible, and the outcomes should be demonstrated in the same level of detail. And number 4, each planned change should be focused on outcome. Initiatives should be prioritised using the 80-20 rule, given that 80% of your results will come from 20% of your activity, so only take forward your top few ideas but execute efficiently. Your internal review should focus on content and not presentation. And most importantly, analysis is performed to identify answers and is not an output in itself. Following these principles will give you clarity of purpose and demonstrate to all stakeholders, including external parties, that you are serious about achieving results. Now for some critical success factors. There are a number of areas critical to your success in reducing cost. In considering the cost of achieving your savings, you should consider the financial impact of go-slows and strikes and include appropriate risks in the total costs. You should establish a clear overview of the risks associated with government grants, government-backed loans, and similar state aid, including coronavirus-related aid. A recent and relevant example of this is the CBILS loans. It's not widely known that any part of these loans cannot be spent on R&D without making it impossible to claim R&D tax credits in the future, because CBILS counts as state aid, which is something for everyone to look out for. You should maintain a clear view of the cost impact of delays, so additional costs can be anticipated as soon as possible. And you should include all costs related to people reductions, such as direct severance, outplacement, and training. Now, a few timing considerations. The development of a clear vision statement of where you want to be at key points in the process so you can check in on progress and keep an eye on the interaction of time and cost to achieve. In order to do this, you should detail the route map that delivers this vision with key milestones, responsibilities, resources, and dependencies identified. Now, this plan should include all aspects impacting timing, such as consultation and notice periods for staffing reductions. And you should resource the plan appropriately with existing staff or external consultants and include buffers to prevent any delays and disruptions to realizing your required savings. Now, in considering the level of savings to be achieved, firstly, you should marry up detailed bottom-up people and non-people initiatives to initial top-down plans and always keep an eye on implementation risks. This will ensure that your high-level vision is backed up with detailed and measurable plans that will impact financial reporting. You should determine the phasing of savings to identify the expected impact on your P&L and cash flow. You will know when to expect results and where, and be able to investigate under or overachievement. You should establish a clear financial baseline that shows where your costs have been historically. From here, you can track benefits accurately and get central and business unit management buy-in through early involvement. And you should use all of this information to prioritize cost reduction initiatives based on value, cost to deliver, and speed. Go for the easy big wins first and fastest. And finally, in thinking about the impact on the business, you should try to align all cost reduction plans to your current ways of working. You can't waste time trying to impose cultural change alongside a cost reduction program. You should make sure that savings and costs are being incorporated into all budgets and that results are being tracked against these budgets. You should utilize existing reporting and meetings to reduce disruption and confusion in the business. And vitally, you should maintain a working organizational structure at all times to allow business continuity with suppliers and customers. Can't take your eye off the ball of your day-to-day business as usual. Now, to discuss some pitfalls to cost reduction programs. There are several common pitfalls that prevent the program from achieving its aims. You may have produced an overly ambitious business plan. You should understand your business and the distress situation. Your finance and operations team should identify a portfolio of evidence-based improvement opportunities that deliver quantified benefits. There may be a failure to manage cash. Your finance team, operations team, and advisors should align to maximize your cash position and minimize the potential for payment issues. Your communication may be poor. You should understand your lenders and other stakeholders' needs and communicate appropriately. In particular, your communication should deliver credibility for you. There may be a failure to understand and act on warning signs. You and your advisors should provide the additional resource required to make sure that issues can be dealt with both at the pace required in distress and in sufficient detail to enable ease of communication with third parties. You may have an insufficiently detailed business model. Your finance team and your advisors should be highly experienced in presenting financial data in credit committee-ready format. You may not succeed in identifying the true potential of the business. You should be able to take an outside-in view of your business and understand what's possible in your sector. Your advisors should be able to do the same, and this enables you to work together to define what the best possible EBITDA is for your company. And you may not be communicating the true potential of the business. You should understand your financial stakeholders' need to see a hard financial rationale for all future improvements and to gain comfort they will be achieved through your early performance against definite milestones. If you avoid all of these issues, you should ultimately end up with an achievable business plan. Your current and prospective lenders should be well disposed to the company. You should be able to see an optimized duration for any negotiations necessary, and you should see lower multiples for any refinanced debt. Now, what are your cost control levers? There are many specific areas to look for cost reduction opportunities across your cost base, and these are your cost control levers. You can make different interventions in your cost base using these levers over both the short and medium terms, depending on your business's needs. Short-term interventions can be made quickly and are generally used in emergency situations where preserving cash immediately is paramount. These measures should not be used lightly as they are generally high risk and have significant potential impact on a company's ability to make profits in the medium term and beyond. Medium-term interventions are preferable, but are suitable for businesses that have the luxury of time. When management has recognized the need for cost reduction before the situation has become critical, interventions can be made that are lower risk and won't hurt profitability so directly. It's worth discussing some of the levers that can be pulled across the different areas of a business in some detail, together with the associated risks. So, for example, in your production and manufacturing facilities, in the short term, you can look at the following. Attempts and agency staff freeze. So any staff that you use in your business that are paid at higher rates than permanent staff should be reviewed for any potential cost savings. And you may find that you can use existing employees more efficiently and reduce the need for double spending. You can look at an overtime freeze, which can save money in the short term, but has an obvious potential impact on productivity. And it may be that optional overtime needs to be limited or eliminated to make sure that your staff cost base is fully predictable. Variable costs are the enemy of accurate cash flow budgeting. A recruitment freeze will avoid additional costs entering the business and will allow natural staff attrition to reduce costs without any associated redundancy and severance costs. It also removes expensive recruitment fees. The risk is, of course, that staff leave and the business is unable to function as it should, and without hiring, growth opportunities that may be profitable in the future are restricted. An R&D freeze frees up cash that is not currently being spent on the day-to-day running of the existing business. R&D obviously is an investment in the future, but the future is of course dependent on survival today. Again, the knock-on risk is that the company fails to keep up with innovations in the market and is overtaken by the competition. The capex freeze avoids leaking cash in the short term, but will lead to aging plant and equipment and the inevitable higher maintenance costs in the medium term. Catch-up capex will need to be factored into any recovery plan where a freeze has been in place. However, you might find that replacement schedules can be stretched without impacting productivity, which frees up cash. And the nuclear option is, of course, a production shutdown. Depending on the type of business, and maybe that this is possible, and existing stock can be used to bridge any gap. But the costs of restarting any production and staff-related costs due to the shutdown should be considered in full before deciding to go down this route. If you have more time and the urgency is less immediate, over the medium term, you could consider revisiting your make or buy or outsource strategy. You could generate significant savings by deciding to buy in products or components that you currently manufacture, or if they aren't available in the market, you could consider outsourcing production to avoid the associated fixed costs and give you additional flexibility to respond to changes in demand. You could look at making plant efficiency improvements. Time and motion studies can reveal sources of potential cost savings from such things as improvements in staff and shift pattern scheduling, less material wastage, energy savings, and so on. The potential here could be huge. Time spent on performing the necessary analysis to identify it is time very much well spent. You could look at your plant footprint and plan a rationalization. Are your facilities in the optimal location? Would moving facilities or consolidating different locations yield cost savings? Would a headcount reduction be possible if operations were brought together and made more efficient? And you should look at any potential for renegotiation of your key raw material contracts. You could consider consolidating suppliers and asking for a discount where this is possible. Suppliers may well be willing to help with your costs, particularly if you are important to their business, and they should want to ensure mutual success. Moving on to consider your distribution network and supply chain. Over the short term, you can think about a few things. You could run down your inventory and avoid holding stock except where absolutely necessary. A just-in-time stock management strategy will free up cash from your working capital that can be employed elsewhere. You should examine your costs in detail with a view to eliminating discretionary spend wherever you can find it. Again, with your distribution and supply chain, you should consolidate your procurement spend to fewer and lower cost suppliers. This exposes you to more risk in terms of supplier concentration, but should yield useful and fast savings. And wherever you can, you should look to reduce staff spend. As with the production savings discussed, you can look at reducing or eliminating overtime and use of external staff where possible. And if you have more time to plan, over the medium term, you could consider looking at your route effectiveness. Are you making the fewest journeys possible using the optimal routes to save on transport costs? Are you wasting fuel and spending on vehicle maintenance because you're doing more miles than needed? Are your staff incentivized to minimize these inefficiencies in the right way? You could rationalize your distribution network. Are you getting your products to their endpoint unnecessarily quickly? Are you using the lowest cost external provider for distribution? Is this something that could be brought in-house to realize savings, or are savings being made by outsourcing? Careful analysis of your distribution network will answer these questions. Again, you can look to renegotiate your existing distribution contracts or consolidate them if possible. And finally, you can go out into the market and identify other sources of procurement. You should make it known that you are open to different options and let market forces help you lower your costs. Moving on to think about sales and general and admin costs over the short term, you should look at things like again, a temps and agency staff freeze and also an overtime or recruitment freeze. Your sales force may not be easily cut, but you should look at how any salespeople are motivated in order to encourage the right behaviour to match your requirement for cash. Your salespeople may be trying to concentrate on long-term profitability when a focus on short-term cash in the door might be appropriate for a period, for example. You could consider a travel expenses policy review and potentially a travel ban where appropriate. Again, a review of all costs to result in a discretionary expenditure freeze should be carried out. And you should look at a property and facility management cost review. Can cash be saved on office space and associated on costs? In the medium term, with regard to sales, general and admin costs, you should look at your sales force effectiveness and determine what return you are getting from each element of your salespeople and processes. You should consider what others in your industry are doing and what constitutes best practice, and you should encourage more of what works and stop doing anything that is inefficient and driving sales. You can consider a headcount reduction after careful analysis of the potential impact on revenue. Consider what staffing model you would need if they all performed at top quartile levels and plan to bring about that level of performance, which is obviously an investment in training costs, but potential long-term saving. Again, you can look at the renegotiation of your procurement contracts. And importantly, in considering your back office functions, you should plan for deduplication where possible. It may be that your operations team are producing analysis that's best done in the finance department, or it may be that key performance indicators are produced across the business by different areas where they could be more efficiently produced and distributed centrally. It's examining what is produced by whom and where, and making sure that that's efficient as possible. And finally, you can consider outsourcing parts of your back office to offshore or other low-cost locations or to specialist providers. It may be that your back office functions can be carried out more efficiently by specialists while you concentrate on doing what you do best and adding value where you can. Many back office functions are purely compliance based and can be done anywhere in the world using information stored in the cloud, saving you time as well as unnecessary overhead costs. So then lastly, thinking about addressing your IT costs. In the short term, you can think about, once again, a temps and contractor resource headcount review in order to identify unnecessary or expensive people. You should look at all open or planned IT projects in order to identify the truly necessary from the nice to haves. And you should look at your IT procurement and contract management. This would involve a third-party service provider review to identify whether you're using the optimal solution from a cost perspective, whether you need to outsource or whether you need to move your contract from a different outsource provider. Over the medium term, you can look at such things as application optimization. Are you using the right software for the right processes, or are you wasting money on licenses for different applications that do broadly the same thing? You can consider infrastructure rationalization and virtualization. Physical servers could be removed, freeing up space and reducing your maintenance costs. And over the medium term, you can take the time to carry out an organizational model redesign, just to fully ensure that your IT enables your business to run as efficiently as possible at the lowest possible cost. So a few lessons from experience. We've discussed a few of the potential options for cost control. Many others will result from a careful analysis of specific situations, and that they'll be different for every business and every particular situation. So those leave us a starting points as places to look for, rather than a one-size-fits-all scenario. There are a few important lessons I've learned from many cost reduction programs. Firstly, a balanced approach to releasing cash and reducing costs quickly, while fundamentally realigning the cost base, is key for long-term sustainability. Businesses should start by taking a holistic approach to evaluating their entire cost base and examining their working capital and margin improvement opportunities. This should be done by focusing on core processes and practices while taking into consideration current risks and controls, establishing a very clear linkage between operational drivers and financial results. That's absolutely key. The implementation of such a comprehensive set of initiatives has to be well executed, coordinated and tracked to ensure the financial benefits hit and stay clearly identifiable on the balance sheet, P&L and cash flow. You need to be able to see the results of your work to demonstrate them internally and externally. It is tempting to rush into a slash and burn cost reduction exercise, but there is a risk of damaging long-term performance or effectiveness as a result of this. So a structured, coordinated and considered approach can minimize those risks. So lastly, a little bit about our offering at Ballards. Our team at Ballards has the depth of business improvement experience to deliver what you and your stakeholders require. We've got extensive first-hand experience of cost reduction across multiple sectors and operational expertise spanning the key business functions. We offer pragmatic, non-theoretical and hands-on support for implementation. And we combine operational know-how with financial rigor, which is the key part. And as a result, we can help you with 5 key things. An evidenced and believable cost reduction plan that reflects the true and achievable potential of your business. We can help you produce a business plan that takes into account your cash restrictions and then phases change in its associated cash requirements accordingly. We can provide a supporting detailed financial model that will increase your stakeholders' belief in the plan and help them to support you. We can help with early delivery of high impact cost reduction to build trust. And we can provide additional experienced resource to make sure that issues with delivery of your plan are identified early, understood and acted on rapidly and with high impact. I'm looking now at the questions. Again, those are our contact details. If you have any questions or want to find out more at any time, then please do get in touch. There don't seem to be any questions in the group chat today. But if anybody has anything else, or yes, I'll wait a couple of minutes, but anybody has anything else, then please do get in touch.
Yeah, I think we were just going over trying to get the screen sorted, weren't we? Thank you very much, James. Has anyone got any immediate questions? We haven't got a massively large group, so if anyone wants to actually unmute themselves to ask a question, then you're more than welcome to. Or if not, pop it into the group chat. Comment from Annette rather than a question.
Yes, absolutely. Yeah, yes, that's right.
Okay. Can't see anyone unmuting themselves, so I'm going to take that as no questions. Comments, thoughts? Okay. Okay, I've just got just one about the presentation actually. Just I've had a couple of people ask if we can share the presentation slides with the group. Is that going to
yes,
be okay?
yeah, absolutely.